All right, so we got a recording going. It's about 6:35, I think, a.m. on Wall Street, 3 hours before the open of trading. It's time to get our global macro on. Let me open up the site. Welcome to QuantBox Live, where we uncover the best fundamental opportunities. Remember, it's fundamental analysis of economic data. It's a snapshot. It's like a balance sheet of where we are in the global economy. Yes, it looks at market sentiment. Yes, QuantBox does technical analysis, but nonetheless, overall, it's an economic snapshot of where one economy is relative to another. They're long-term trends. It may not describe what's happening in the market today, but there are many tools that QuantBox has to help you align both short-term and long-term. Ultimately, your decision of what you want to do, let's say not even today, tomorrow, next week, next quarter, next year, those are decisions that QuantBox will help you make quantitatively. So when you get to the dashboard, for example, it's a snapshot of where all these different markets are right now. Not just price like at the top, but a basket of risk on and risk off assets, plus a scatter plot. All of this is real time, right now data. So you can call that sort of sentiment. And then here is more of the balance sheet of the market. Where are the bulls? Where are the bears? What are the trends? How are things correlating? Then you can drill down, of course, and say, hey, looks like fundamentally the stock market is set to fall based on the economics. If you look at seasonality, set to fall. If you look at technicals, set to fall. Retail doesn't know what's going on. And 66.62% of institutional investors are short. Maybe you should be short too. I mean, it's that logic, it's that process. Okay. What's moving the markets now has to do with the central banking forecasting tool, and institutional investors are thinking about what will happen next year. See, retail doesn't think that way. Institutional does think about next year. The big rally in November had to do with a, a, a revision of future expectations in interest rate policy. And now what's happening is profit taking as just sort of institutional maintenance. It's nice to know. That's why I'm here every morning. So, anyways, hey, if you're watching this on YouTube, guess what? You're watching it many, many, many hours late. Why don't you just join QuantBox? Take the trial, less than $8 for a whole week. You get a 16-hour training course along with it. Sweet. You're going to get your $8 worth. And then you'll say, you know what? Confidence is worth $79 a month. Wow, look at that. Don't click that. Wow, what just happened? Anyways, let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money cannot afford to lose. Okay, let's get in there. Oh yeah, I know why. That's by the way, it's me that's making the mistake here. I'm not moving things around the way the system wants it to. That's not the latest video. If you go to live strategy sessions, shame on me. You just gotta go. Yeah, see, it wants to do it in reverse order. Gee whiz. Sorry, my bad. Yeah. Oh wow. What's the date today? The 5th. Yeah, so that was it. So that's my bad. I will update this. So I apologize. So here's yesterday's recording. I don't need to make you, I don't, right, to make so many clicks. But anyways, I will do a better job. I hope to promise. All right. So let me log into the cloud and let's get going. Do, 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 do. Okay, yields are still good. I'm okay with that. Although there has been some volatility in this market, it doesn't really seem like there is, but there is, right? There has been, but nonetheless, this is okay. Oil, okay, is actually in the spot market down right now, which is we'll take a look. We have to look at that chart. We're right on the line again. Gold, S&P, okay, both of these I would say are interesting. Remember, gold, what 24 hours ago was $100 more an ounce, so it's down and stable now because it's right back to where it was before the geopolitical risk. S&P 500, yeah, not up. It's flat, but remember, NASI is down and Dow is up, which shows the rotation, which we talk about. It's very important. It's a little early this year, but people made too much money too quick this year. Yeah. I mean, that's just it. They're like, really? How much did I do in November? Now they're looking at year-end bonus. They're like, you're 1% above your year-end bonus requirement. You're like, I'm done. you, you don't want to lose that 1%. So you're like, I'm done. Yeah. And that's really what's happening right now. But and then Bitcoin, yeah, still up. Man, oh man. Man, oh man. Man, oh man, that is something else. Let's take a look at the risk gauges. Are things changing? Not a lot, huh? Not a lot. Long term is still long, and everything else is mixed, which I think shows that any sort of many of the moves that are occurring are simply profit taking, not selling, because it would be hard red, it'd be hard bearish, right? Hard bearish, risk off. Not quite happening. Let me go full screen here. All right, so what's working? Euro's working, huh? Oh, snap. Did we set Remember just yesterday, Euro's the weakest link. I'm like, hey, you could go around and look for maybe opportunities. And we spent some time finding support on things like Euro Aussie. Wasn't Euro Aussie seriously one of them? It's not something that I do. I'm not a big Euro Aussie fan, but we were talking about this. If it wasn't here, it was at Investor Bootcamp. But I think it was here because I was talking about you need to use the tool to think forward. You can't look at everything that's already moved and then set up today's move based on that. No, it's already happened. Okay. I mean, that's not even hindsight. That's no sight. You're just doing what has been. And what you'll find if you just trade what's working right this second. Oh, that's right. We spoken. That's right. You're okay. Thank you for that. Um, so, anyways, what you need to do is find out what has happened and then set up what you think is going to happen next. Just trading what's happening now, what'll happen is you'll be late into trends, but because trends are trending, which they tend to last a bit amount of time, they you'll do that for a while and you'll be late, but you'll catch half of it. And then because you don't understand about planning future, then it'll come back, but you'll say, well, it's been in an uptrend. Well, it wasn't an uptrend, but now it's pulling back and you don't do anything. And then what happens is, and you end up at break even again. So if you're pretty good at technical analysis, but you find that you make 5% and then you lose 5%, you make 5%, you lose 5%, you make 5%, you lose. It's because you're probably trading in the middle of trends and not preparing in advance for new trends or the end of trends. And you're like, I'm really good at technical analysis. Yeah, you're really good at getting late. Okay, because fundamentals and then quantitative analysis helps you plan for the future before it's happened, not responding to what happened 3 days ago. Okay, so anyway, so congratulations on being pretty good on technical analysis. Okay, good. So that's right. And by the way, I haven't told the development team that these are lagging. It's just we're working on bigger stuff at the moment. So yeah, that's right. So we were looking at browser. What is going on? This is what I'm trying to get. Okay. Money flowing into the pound. I think one of the things that's going on here is future expectations of interest rates. So why did all this money suddenly go into the pound? I think interest rates are being interest rate cuts are being priced in for the US dollar, and interest rate cuts are being priced in for the euro. But because look, and I was trying to think about why that would be happening. If the United States is pulling back next year, then the ECB kind of wants to follow. Plus, it needs to save Germany. Have you looked at the German manufacturing data lately? It's horrible. It's beyond horrible, right? So if the Fed eases, then the ECB could ease and all that kind of stuff, because the ECB has to worry about so many different economies. What about the UK? It can focus on itself. The BOE is just, dude. And yeah, they might be in a world of hurt, but they still have way too much inflation. So if they do cut next year, like all the other central banks are expected to, it'll be a lot less. So take money out of euro and put it in pound. The relative change is different. You see? So if they, let's say all assets become bearish next year, which is not what I'm saying, but think of the analogy. If all assets became bearish next year, Great British Pound might be the least bearish. And institutional investors made that decision by Tuesday of last week. The thing is, now that you know, what will you do with that information? It's power. Use it responsibly. Use it for good. And so now with this going on, people are trying to figure out I'm way out in the middle of nowhere. We're going to cut. I think what this narrative now is they're pulling these cuts forward. If the Fed goes, the ECB goes. Remember, the Fed is the reserve currency. So it matters, right? It's almost like they're the de facto policymaker, and then everyone else has to respond. Why? Because the Fed is smarter. Oh, I don't know about that. But because they manage the reserve currency, right? Yeah, it's power, isn't it? It's the gun in the hand of the gangster. Okay, so if the Fed is a global gangster, the gun is the U.S. dollar. Okay, you might not like the gangster, but he's got that U.S. dollar. But ciao. So, anyways, be careful. Be careful of my analogies. They're dangerous. Yeah. Um, all right, cool. So, anyways, this is different, but I think the market is ignoring. And then when I go to the US dollar, you can see this changed dramatically after the SEP. And so the market's pulling this forward, and this is what's being traded. Um, the real worry here is credibility from the Fed, right? Because if you start ignoring them and then it doesn't matter, um, it doesn't matter what they say. And that's actually been happening. You notice that This was much flatter a few months ago, and the market's like, yeah, no, you're wrong, Fed. You say one thing, but we know you're gonna do another. And that's actually quite dangerous. But nonetheless, I don't want you guessing and gambling. Okay. I want you to manage your money not like a hedge fund, but like an endowment. Anybody want to gamble their retirement account? You double it and triple it, and then you turn 60 and you blow it up and it goes to zero. Anyone want that? Well, that's what hedge funds do. See, what you don't hear about hedge funds, you always hear the ones that made $1 billion in a day kind of stuff, right? What you don't know is they start a fund, they raise money, other people's money goes into the fund, and then they gamble it. And if it works, you hear about it. And then they get 10 times as much money on the second fund. Why? Because the first gamble worked. So now they go from 1 billion to 10 billion. Now they start a completely different fund. It's a different corporation and everything. And they put all that money in there and they gamble it and they blow it up. It's an interesting business model because you don't get paid on the second one, but the first one worked really nice, and now you live in a mansion, and you drive around in a Bentley, right? And you get paid to do stuff like that. You got to be careful. And if you're trading your money, you don't want that kind of volatility, right? Okay. So CAD has really changed recently, and this tool has really shown you. Kiwi was the weakest, and the other central banks are catching up hard and fast. Like nothing was as bearish as New Zealand was, not even close. Remember, and now it's very, 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 very bearish, which sets up what we might be doing next year. Um, hmm. And it shows you that even if yield curve control doesn't change, there's not a lot of things to buy, right? And suddenly, like the yen should be weak, but nothing is worth buying. Uh, you know, um, this. I mean, it's going to be interesting next year. It's going to be interesting. Like, I'll put this out there. Like, imagine we were in a class and I gave you a weekend assignment. And you had to write a 5-page paper, and I say, what will the Bank of Japan do if their yield curve control doesn't change, but just stops working because there's nothing to buy? Why would you borrow a bunch of yen, weaken the yen by using the yen to buy something else when there's nothing to buy? What will the Bank of Japan do to hit their goals? You know, if it stubbornly won't go from 150 to 200 US dollars, right? Yeah. So is that enough to unwind the whole Japanese yen move? I don't know. So there's sort of like the supply side and the demand side, right? That we don't always really think of it that way. Like when it comes to oil, we always think about that way. But usually you don't think about supply and demand for dollar or other currencies because usually one is almost fixed and the other one doesn't change very often, right? One only changes when there's a monetary policy change. But what if there is a demand change? So like the yen is beautifully cheap to borrow. You can get it for like negative interest rates. They'll even pay you to borrow it. Okay. Cool. But what if there's nothing to buy? Or like how about this? What if you could get a mortgage for free? But there's no houses to buy. Does it help? No. What if money's free, but you have to have exceptionally good credit. And if you don't have exceptionally good credit, there are no mortgages. It's either free or you don't get one. So if you don't have exceptionally good credit, does it matter that interest rates are free? Right? There's just no demand, except for the lucky chosen few. Okay. Which is actually how I ended up buying a house in the 2008 financial crisis. The reason I got it is I had the best credit. That's the secret, isn't it? That's the secret to the Western world, anyways. It's not how much money you got, it's how good your credit is. Yeah, because you can leverage your credit. Anyways, so right, no one else could get a mortgage at that time, right? And I could get a mortgage for free. There's a big difference. So, anyways, think about it on a global scale like that, right? So you could get Japanese yen for free, but there's nothing to spend it on. So do you then borrow it? What's the point of borrowing if you can't spend? Okay. So, anyways, I don't know. Could be interesting. Okay. And what I would like to see is a weak dollar. That's great. Okay. So that's okay. So where are we now? Fourth quarter? No, that's next year. Fourth quarter this year. Okay. This is where interest rates are, right? 5.25 to 5.5. The mean is 5.43. And already slight cuts, slight change down. Notice it's not below 5.25, but it's the decision of FOMC measures, participants. It's their mean price. So some members of the FOMC, not many, maybe one person, is saying, yeah, I'm open to cuts in the first quarter. But look at this drop. Enough of the voting, or no, again, I say voting, it's all members, even non-voting members of the FOMC. When you look at the opinions of the presidents of each Federal Reserve Bank and the Board of Governors, there's enough members that have said in their forward guidance a cut in the second quarter. Okay. Cool. Cool. And that's what's happening. Many are pricing in that we get below 4.75 to 5 by the third quarter. But remember, we also have an election year. So some might say, well, then you got to pull this forward. Okay. So, anyways, yeah. Oh, now I'm stuck there, huh? Cool. And well, we'll leave it there then. And at that point, we'll have inflation below 3%. It's going to be tough because if you break inflation into two components, products and services. Okay. Product inflation was very high because of the supply chain. And most central banks, like I believe the RBA, the RBNZ, the Fed, I believe it was the Bank of England, all specifically said in their speeches, their recent speeches, that product supply chain type inflation is down. Okay. What about services? And I believe all the same central banks said the same thing. Services are actually still up. They're not as high, but they're not falling. Like if this is a big down arrow, this is a tiny down arrow, service side. And the issue with that, of course, and we talked about this, you know, a year ago, a year and a half ago, when we first got hit with all this situation, um, that wages and rents are sticky. Okay. The landlord doesn't lower rent until all is then until half the tenants have left because they have already lost their jobs. So if we don't go into recession next year, no one's going to lose their job. Rent ain't going to come down. Same thing. Like, why would wages be going down? The only way to get wages down is that we go into recession and people lose their jobs. So if we're pricing in um, falling inflation, moving back to target, and avoiding a recession, all of a sudden the narrative doesn't really actually work. So, yes, inflation is way down and expected to fall, but is it possible now that we got this side of the equation down quite a bit? Is it possible that year over year, let's say from November 23 to November 24, product side inflation is flat? Like, if it's already back to normal, will it fall even below normal? No, probably not. That would be abnormal. We've solved that problem. We don't have that inflation. So then how do you get the headline down if services stay high? Okay. So either inflation doesn't fall as expected and interest rates don't fall as much as expected, or we are going into recession, which is not expected. But there's the market, right? Quote unquote, the market, the aggregate of all the bullishness and bearishness of next year, okay, is somewhat wrong. Okay. Or they're right, but for the wrong reason. The Fed cuts next year because the economy is going into recession. Okay. Well, we don't see that yet. What we do see in the market is profit taking. Beautiful big move, huh? That we've had here on Bitcoin. Again, I'm just want you to focus on the technical trend here. Okay. October and November tend to be quite bullish months. Wait, one, two, labor market -3. Wow. Um, November, December tend to be really good months. Okay. Look at all I love the statistics there. Maybe it's maybe we need to look at 34,000% over 10 years. Anyways, December is a bullish month, but not so much. Okay. But the last few months have been very good for Bitcoin, and that's fairly normal. And that continues to about March. Kind of interesting. This I don't trust. So again, we're going through big revision, big updates and upgrades in QuantBox. So this is one of the pet projects to work on. Okay, working its way up. If you look, if you calculate the mean, you can tell by what it's doing. Stupid tool. All right. If you look at the mean, this is the mean. Okay. I can tell from the linear projection. So what we're concerned about is it. Remember, it's only saying if what has been happening continues to happen forever without any change, that's where we will be in the future. Okay. So you want to watch sort of like when you start to get technical trends now, not statistical trends, but technical trends, then then you got to watch out. And remember, we know it's the first week of December, and we know within 4 weeks of now, between now and the end of the month, there will be profit taking. Okay, we talked about this before Thanksgiving. It could even start before Thanksgiving. Usually not. Usually not. But I said definitely, definitely, definitely. Even like a year ago, even 5 years ago, some of you guys might remember the speeches. 12-12, right? You guys remember that one? 12-12? Probably want to be out by December 12th. Why December 12th? Because 12-12 is easier to remember than 12-13. Okay. 12-17. I don't remember. Is it 12-17 or 12-16? Yeah, but it's still a rough idea. Like, yeah, by the middle of December, time to cull the herd if you haven't already. This year, because there was so much money made last month that it seems to be happening sooner. In other years, it's later, but there's a hard deadline. There's year end. For tax reasons and regulatory compliance reasons, yeah, if you're going to go to profit, you got to go to profit in the next 4 weeks. And then the next 4 weeks might be now. And so, anyways, much of these pullbacks that you might be seeing in these markets, it's not actually bears selling, it's bulls selling. It's a big distinction. So let's take a look at some of these assets. So oil has been coming down, and we are still on the line. 24 hours ago, we were talking about the very, very interesting opportunity to maybe get long this. Okay. But the actual reality that this is the sell zone. Now, we didn't have that spike yet, but I did draw the circle just like I did now. And here we are in another one. Okay. And what it looks like, okay, and I want to frame it that way. What it looks like right now is that this is going to fall forever. Cool. Now, if you're a bull, that's not a great opportunity. But if you're a bull and suddenly you see a change, now you can get involved, but not until you have qualified the opportunity with technical analysis. You have to believe that we don't have enough oil in the world. Now, the United States is producing it as fast as possible. Okay. OPEC is cutting, could cut more. They could cut, they could cut, they could cut. They could. Okay. They can't. Now, I don't think they're real cuts, and that's the issue. They're cutting stuff. The OPEC cuts. Remember, there's probably 15 different types of oil out of Saudi Arabia alone. Now, if you take all the OPEC and Russia thrown in there, there could be, let's say, 25 different types of oil. So when they say they're cutting oil, what are they cutting? The oil that nobody's buying anyways. You weren't buying it? Well, they're like, well, we ain't selling it. Yeah, okay, great. Okay, great. And so the market can see all of this, but so the right, so there's the supply side equation of going on. The United States is producing a lot, and Russia and Iran are selling a whole bunch to China at cheap prices. That means the market price for all oil, right? All crude products would fall. Because even if it's not the official price, it's happening. Okay. So, anyway, so we have all of that. And there's some pricing in of a global recession next year. Okay, cool. Cool. But what about the future? If demand picks up and the United States is already producing at maximum, and really OPEC is producing all the wanted oil at maximum or nearly, um, what could happen in the future? Well, that's great. That doesn't necessarily have to happen today. But if you were following a narrative like that, you need to be paying attention quite closely to what's happening now. 72 and a half is a number that we've had on this chart for a very long time, and we're there now. So if you have a bullish narrative, not based on supply, but maybe a demand coming and we can't meet it, whatever, geopolitical risk, whatever. Um, this type of trade starts as a range trade because it is a range. What can I say? If you believe it's going to go up forever, well, that's not technical analysis. That's hopeful wishing. But if it did this, then yeah, yeah, yep, yep. Okay. But right now it is bearish, but right now we are in support. And I would say bearish trending, but consolidation with the possibility of reversal. Okay. Okay. So it's like cloudy with a small chance of rain, or I guess it'd be the opposite. It's cloudy, but we expect the cloud cover to burn off and be sunny in the afternoon. I don't know, but it might rain. So don't get caught between narratives. Pick one. Okay. It's either falling forever and you're following the moving averages. Sure. And of course, you're also following the bearish side of these pivot points, right? This is the bearish selling zone. You can't see it, but I can see it with my bionic eyes. Okay. Those are the selling zones. So as a bear, you're following that. And that is happening, but we just don't know if it'll break bottom. Okay. And this would be another beautiful place to sell if it does break the bottom. And then, like I've shown you, it probably will drop another $10 to $15. Could be. Today, no. But that is what is happening. It's non-debatable. But if you're a bull and you see this in the next day or two, yes, you got to get in down here. Don't wait for it to be up here. Okay. Because then you go back to that. You trade it here, you make money for a while, and then you're out at break even. And if that is the case, if that's what happens to you over and over and over again, you are better being aggressive down here as a buyer, and you're better off being aggressive up here as a seller. And the mediocrity in the middle just doesn't pay the bills. So don't be in the middle. Yeah. Pigs get slaughtered. And by whom? By the bulls and the bears. They get trampled. You're fighting everybody, including your psychology after a while, right? Because then you beat yourself up. So, right? Be ready, willing, and able down here as a bull. And you sit and you wait, you sit and you wait, and you sit and wait, and it doesn't turn bullish. Good. You didn't trade. And the other thing that you have to train yourself on, if you don't mind me adding it, if you wait for a bullish trend, okay, or let's say you're waiting, you're trading the bearish trend, and you sell here, but it does one of these things and reverses. You have to train yourself that the market lied to you. And then I used to say this out loud too. Like you might think I'm joking, but I actually did all this stuff. I would yell, like, let's say I sold this, right? That's the plan to sell here. Lower low, lower high, do that all day, every day, right? Now I have to stay strong in what almost always works, but doesn't always work. Almost always works, but doesn't always work. So how do you handle psychologically it does this and reverses on you? I say out loud, what kind of idiot? What kind of idiot buys a lower low? What a knucklehead. What a loser, right? And it's not my fault. Someone with a lot more money than me did something incredibly stupid, but I can't fight it. If it reverses, it reverses. So I take a loss there and I watch the whole market reverse. And then, I go back and I redo my analysis. But of course, lower lows usually set up lower highs. Lower lows usually don't create higher highs, right? But we do know that can happen. Um, but usually it happens in trends. So you get a higher high, higher low, higher high, higher low, higher high, higher low, higher high. Whoa, whoa, whoa. What do we call that? Head and shoulders or crown. Specifically, that's a crown, but nonetheless, that does happen at the end of a trend, right? So this isn't actually a trend. So we just got to pay attention. Um, it's better to be bearish up high than bullish. It's better to be bullish down low than bearish. And so the bulls are supposed to buy this. And so if they don't, then it's okay to try. And in that first wave, okay, it might do this instead. Don't worry about it. It's okay. The patience and discipline that you exhibit are worth a million times more than that one little trade where you got to fake out and reversal. It's okay. Probably won't happen. And if it does, because you use proper risk management, you won't lose a lot of money. You'll just move on to the next trade. Peace on earth. May the pip